Debt market update, April 2023. G-Sec yields trended lower during the month, primarily because of unexpected pause by RBI as against consensus expectations of 25 basis points rate hike. The yields fell further driven by inline inflation print, lower yield cut off in the G-Sec auction during the end of the month, and US yields trading with downward bias. The 10-year G-Sec yield ended the month at 7.12%, down 19 basis points. Corporate bond spreads over G-Sec remained largely unchanged. Average interbank liquidity turned into surplus in April 2023, driven by seasonal factors and higher government spending. Notably, government has drained down its cash balance and also utilized the Ways and Means advance facility in past 2 months. FPIs bought debt worth $0.3 billion in April 2023. Cumulatively, FPIs have bought debt worth $0.4 billion in 4 months CY23, vis-a-vis being net seller of $1.8 billion during the same period last year. Outlook: the minutes of monetary policy released during the month were perceived slightly hawkish vis-a-vis expectations, with most members highlighting resilient growth and reiterating that war against inflation is not over. Most members also stress that MPC is ready to hike rates if the need be, and by keeping the stance unchanged, RBI has retained the flexibility to pause or hike further depending on data. Going forward, several factors seem favorably placed for the fixed income markets. CPI has eased from the peak and is likely to ease further in view of softening momentum, lower input price pressure, correction in global commodity prices. Further, growth is also likely to moderate on the back of exports slowing, fiscal impulse declining, and private consumption normalizing. Current account is likely to improve sequentially, driven by lower oil prices and robust services exports. Further, the easing of the US dollar from the peak and adequate foreign exchange reserves should take pressure off Indian rupee, despite uncertain outlook on capital flows. On the fiscal side, budgeted market borrowings for FY 23-24 were in line with market expectations. Also, in our opinion, most major central banks, including the RBI, seem to be close to the end of their rate hiking cycle. Moreover, the bar for future rate hikes is high, and therefore an extended pause seems probable at this stage. All the aforesaid factors bode well for the fixed income markets. Key risks to the outlook are elevated core CPI, resilient domestic growth, robust credit demand, and continued global monetary tightening. Heightened geopolitical risks, elevated oil prices, tight liquidity, lower demand from insurance sector, an increase in issuance of state development loans in FY 23-24 are other important factors which could keep the yields at elevated levels. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into the short to medium duration debt funds, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.